Welcome to this deep dive. Today, we're tackling a really foundational topic you asked about, the U.S. federal income tax system.
Yeah, and we'll be using the Federal Income Tax 3rd Edition QuickStudy Law as our guide. So extracting the key stuff you need.
Exactly. Our mission really is to give you a clear, concise understanding, how it's structured, how it actually works.
We want to hit those key elements, give you those like aha moments without getting too bogged down.
Yeah, none of the overwhelming complexity, just building a solid framework in your mind.
Right.
So we're going to explore the IRS, the Internal Revenue Code, then look at administrative pronouncements, judicial doctrines, how they shape the law.
And finally, break down those core definitions. Income, deductions, credits, and basis.
Okay, let's unpack this then. To start, what are the absolute, must-knows, the bedrock?
Well, the bedrock of the U.S. federal income tax system, it really rests on two pillars: the Internal Revenue Service, the IRS, and the Internal Revenue Code, the IRC. The IRS, as a source says, it's basically the enforcement arm of the Treasury Department, their main job.
Yeah.
Making sure people comply with the tax laws.
And they actually put out a lot of info themselves, don't they? I mean, irs.gov, the guide mentions it's packed with forms, instructions, publications.
Tons of resources. Rulings, even links to other legal stuff.
It's almost like they're saying, here it is, figure it out. Well, maybe not quite that simple.
Huh. Well, they provide the tools. And the Internal Revenue Code, the IRC, that's the actual text of the federal tax law. It's Title 26 of the U.S. Code.
So part of the official U.S. laws.
Exactly. So you've got the IRC is the law itself, and the IRS is the agency that, administers and enforces it.
Right, the what and the how. But laws, they often need interpretation, don't they? That's where these administrative pronouncements come in.
You got it. The IRC sets the big picture, but the nitty-gritty often comes through these pronouncements. First big one, Treasury regulations. Right. Issued by Treasury, but interestingly, drafted by the IRS folks. Their whole purpose is to interpret and give detailed guidance on the IRC's language, which can be pretty general sometimes.
So they flesh it out.
Yeah. And what's neat is their numbering system. It links directly back to the IRC section they're explaining. So if you're looking at a code section, you can find the matching regulation in Title 26 of the Code of Federal Regulations, the CFR.
Gotcha. Like the detailed instruction manual for the tax code. What about revenue rulings? They sound more specific.
They are. Published revenue rulings are the IRS's official take on how the law applies to a specific set of facts.
Okay.
Each ruling lays out the facts, the IRS's view, and a quick explanation. And the key thing, once published in the Internal Revenue Bulletin, that's their weekly publication, they have presidential value.
Ah, so not just for the one taxpayer who asked.
Right. Beyond that specific taxpayer. It's not like a court decision legally binding on everyone, but, if there's a bunch of rulings pointing your way, it definitely helps your case in an audit. Shows the IRS's stance.
Okay, so revenue rulings give a broader picture of the IRS's thinking. Now, private letter rulings, PLRs, and technical advice memoranda, TAMs, they sound even more individualized.
They really are. A taxpayer can ask for a PLR before doing a transaction, basically saying, hey, IRS, how will this play out tax-wise?
Proactive.
Yeah, though the IRS won't rule on purely factual stuff or things on their no ruling list. TAMs, on the other hand, those come up during audits. An IRS agent might ask the national office for guidance on something that's already happened.
Seems super useful for complex things, but there's a catch, right? I remember reading that.
Huge catch. Absolutely critical. PLRs and TAMs have no legal precedential value. None.
Okay.
They apply only to the taxpayer who requested it. And for a PLR, it only holds up if the facts given were accurate and complete.
So helpful for that one person, but you can't waive someone else's PLR in court and say, see?
Exactly right. They don't set a legal standard for anyone else.
Got it. So lots of guidance from the admin side, but varying levels of legal weight. Okay, so what happens when things go wrong? When you and the IRS just don't agree, tax controversies.
Right. Well, it depends if it's about an overpayment or an underpayment. If you think you paid too much tax.
You want your money back.
Yep. You file a claim for refund with the IRS.
Yeah.
If they deny it or just don't answer, you can then sue the government, either in a U.S. district court or the U.S. Court of Federal Claims.
Okay. And if the IRS says you owe them more?
That's an underpayment situation. Typically, you'll get a notice of deficiency, often called the 90-day letter.
The dreaded 90-day letter.
Kind of. But it gives you an option. You can fight that assessment by filing a petition with the U.S. Tax Court.
Okay.
And interestingly, if you do end up in court, and let's say the government's position was just like totally unreasonable.
Yeah.
You might actually be able to get them to pay your attorney fees.
Oh, wow. That's a pretty significant protection for taxpayers. Good to know. Now, deadlines. Tax always has deadlines. What about statutes of limitations here?
Yeah, crucial stuff. Generally, the IRS has 3 years from when you file your return to assess more tax. 3 years.
Okay, standard window.
Big exception.
Hmm.
If you significantly understate your income specifically, omitting more than 25% of your gross income, that window extends to 6 years.
6 years. Wow.
And the source points out, overstating your basis, your investment cost and property, counts as omitting income for this rule.
Ah, good detail.
Also, there's a rule that can pause the clock for filing a refund claim if you are unable to manage your affairs due to a physical or mental impairment.
So the 3 years isn't totally set in stone. What if the IRS believes you owe and wants to, collect, take action?
Before they can actually levy your property, like seize assets to pay the tax debt they have to give you notice, a notice saying you have a right to a hearing.
That's important. A chance to respond before they take stuff.
Absolutely. It's a key procedural safeguard.
And if you just disagree with their initial finding, what's the first formal step within the IRS?
You have the right to an administrative appeal. You can take your case to the IRS Office of Appeals.
Okay.
The materials say you're entitled to an explanation of how it works, and the whole point of this appeal process is to try and resolve things informally. Keep it out of court if possible.
Like an internal review, a second chance within the agency.
Exactly. Try to settle it there.
But if that doesn't work, then it's off to court. Trial court litigation. Sounds like it gets serious then.
It can, yeah. But the source lays out the 3 main courts pretty clearly. First, the U.S. Tax Court.
Okay.
Big feature here. If you get that 90-day letter saying you owe more tax, you can generally take your case to tax court without paying the disputed tax first.
Ah, litigate first, pay later if you lose.
Pretty much. Their power is mostly limited to reviewing those IRS deficiency claims, though they can order refunds or payments and do some specific things like rule on tax-exempt status. Crucially, no jury trial. The judge decides.
No jury, judge only, argue before paying. Got it.
What are the other options? The other 2 are U.S. District Court and the U.S. Court of Federal Claims. Now, for both of these, you generally have to pay the tax first, then sue for a refund.
Pay first, sue later, opposite of tax court.
Right. Big difference with district court. You can request a jury trial there.
Okay, so if you want a jury, district court's the place, but you got to pay up front.
Correct. The Court of Federal Claims, also pay first, has no jury trials, and it mostly sits in D.C. Tax court judges are based in D.C. too, but they travel around the country to hear cases locally.
More convenient, potentially.
Can be. Oh, and tax court has a simpler small case procedure for disputes under $50,000. It's less formal, but the decisions aren't precedent, and you can't appeal them.
So choosing the court involves strategy. Jury or no jury. Pay now or later. Even thinking about appeals.
Definitely. Because where you appeal depends on where you start. If you lose in tax court or district court, your appeal goes to the U.S. Circuit Court of Appeals for your region.
Geographic circuit.
Yep. But if you start in the Court of Federal Claims, your appeal goes to a specific court, the U.S. Court of Appeals for the Federal Circuit.
Interesting.
And from any of those circuit courts, the next stop could potentially be the U.S. Supreme Court, but they only take a very small number of cases.
They have to grant cert, right?
Exactly. So, yeah, as you said, the precedents already set in your particular circuit court can really influence which trial court you might choose in the first place.
Gives us a clear map of the dispute process. Okay, shifting gears a bit. How do courts actually interpret tax law? The source talks about judicial doctrines. What's that about?
These are super important. They're like court-made rules or principles, developed over years to stop taxpayers from using loophole-y transactions that technically follow the law's letter, but are really just about dodging taxes with no real economic point.
So, anti-abuse rules created by judges.
Sorta, yeah. The source mentions several common ones, like the sham transaction doctrine. A transaction can be a sham, in fact, meaning it never really happened.
Like it was just paperwork.
Right. Or it can be a sham in substance. It happened, but it had no economic purpose other than tax benefits. The courts basically say, nice try, but there's no there economically.
Needs real economic meat on the bones, not just tax avoidance. What else?
Then there's the economic substance doctrine. Very related. It says a transaction needs to actually change your economic position in a meaningful way, besides the tax effect, and it needs a real non-tax business purpose. Congress actually wrote this one into the law now, too.
Okay, so it has to make business sense beyond just saving tax.
Yep. And the step transaction doctrine, this lets courts string together a series of separate steps and treat them as one single transaction.
If they're all part of one plan.
Right. If the steps only make sense together, or if they were all pre-planned to reach one specific outcome, you can't just break a tax dodge into tiny, innocent-looking steps.
Makes sense. Prevents gaming the system through complex steps. What about business purpose?
Closely tied to economic substance again. Courts can ignore a deal if its main point was tax benefits and it lacked a real business reason. And finally, a big one, substance over form.
That sounds fundamental.
It is. Courts look at the underlying reality, the economic substance, not just how you labeled it legally. Calling something a loan doesn't make it a loan if it really acts like an equity investment, for example.
So labels don't matter as much as what's actually happening. These doctrines seem to give courts power to enforce the spirit, not just the letter, of the law. How do they approach interpreting the actual statutes and regulations?
Well, the starting point is always the plain meaning of the words in the law or regulation. If it's clear, that's usually the end of it.
If the text is unambiguous.
Exactly. But if it's ambiguous, open to interpretation, then they might look at legislative intent. What was Congress trying to achieve with this law?
The purpose behind it.
Right. And there's this important idea called Chevron deference from a Supreme Court case. Generally, it means courts give weight or deference to how the IRS interprets the law and its final regulations. If those regulations were made properly, with notice and public comment, and the interpretation is reasonable.
So if the IRS interpretation in a final reg makes sense, courts tend to follow it.
Generally, yes. It's like Congress told the IRS, you figure out the details, and if they do it reasonably, courts back them up. Proposed regulations, though, courts see those more as just the IRS's argument in a potential lawsuit.
Just their position, not owed deference.
Right. And as we said before, rulings and things like that get even less weight from courts, sometimes none at all.
Okay, so there's a clear hierarchy. Statute, final regs, rulings, other IRS stuff. Useful framework. Let's get into the building blocks now, the core definitions. Starting with income. Seems simple, but probably isn't.
Yeah, it's broader than you might think. Gross income, that's the starting line. Section 61 and nearby sections, it's defined very broadly. Income from whatever source derived, unless the code specifically excludes it.
Whatever source derived, so pretty much everything.
Pretty much any time you get wealthier.
Yeah.
Cash, property, services, even if someone cancels a debt you owe, it all counts before you take any deductions.
So the default is it's income, unless Congress explicitly carved it out, and those carve-outs are exclusions.
Exactly. Exclusions are specific things Congress decided not to tax. You find them in sections like 71 to 90 and 101 to 140. Think gifts, inheritance, certain fringe benefits, but courts interpret these narrowly. If it's not clearly listed as excluded, assume it's income.
Okay, gross income minus exclusions. But that's not the final number, right? Then comes adjusted gross income, AGI.
Correct. AGI, defined in Section 62, is your gross income minus a specific list of deductions. These are often called above-the-line deductions.
Above the line.
Meaning, you take them before you get to the line on the tax form where AGI is calculated. Section 62 itself doesn't create deductions. It just lists which ones qualify for this treatment. Things like contributions to a traditional IRA, student loan interest.
Okay, so you subtract those regardless of whether you itemize later.
Exactly. And then after AGI, you subtract your other deductions to finally get to taxable income.
Taxable income. That's the magic number the tax rates hit.
That's the one. Section 63. It's your AGI minus either the standard deduction or your itemized deductions. That's the base for calculating the actual tax you owe.
All right, income is definitely layered. Let's talk deductions. These reduce the income that gets taxed.
Yes, deductions lower your taxable income. But remember, nothing is deductible unless a specific code section says it is. No general right to deduct expenses.
Got to find the rule that allows it.
Precisely. The source groups them. Some for all taxpayers, like business expenses, some just for individuals, like medical expenses if you itemize, some just for corporations. And then there's a whole list of things you explicitly cannot deduct, like personal living expenses.
Right. And individuals have that choice, don't they? Standard versus itemized.
Yeah, every year. You take whichever is higher, the standard deduction amount for your filing status, or the total of your specific itemized deductions, things like certain state and local taxes, up to a limit, home mortgage interest, charitable gifts.
Whichever saves you more tax.
Right. Oh, and worth noting, the deduction for personal exemptions for yourself, spouse, dependents, that's temporarily zero until 2026 under current law.
Good reminder. Okay, so deductions lower taxable income. Credits sound even better. They lower the actual tax.
They are generally better, yeah. Dollar for dollar savings. A $100 credit cuts your tax bill by $100. A $100 deduction only saves you $100 times your tax rate.
Big difference.
Huge.
Fair.
Credits are in sections 21 to 53. Two main flavors, refundable and non-refundable.
Refundable means?
You can get it back as a refund, even if it's more than the tax you owe. It can take your tax below zero. The earned income credit is a big example.
Okay. And non-refundable.
Can only reduce your tax down to zero. It won't generate a refund itself. Lots of credits are non-refundable.
What are some examples the source gives?
Let's see. Dependent care credit, adoption credit, the child tax credit, which has refundable parts, education credits like the American Opportunity Credit, the Savers Credit for retirement savings, also mentions the residential energy credit, and various business credits. Lots of specific incentives packed in there.
Definitely can add up to significant savings if you qualify. Okay, last big definition. Basis. This one it always felt a bit abstract.
It's crucial, though. Basis is basically your investment in property for tax purposes, what it cost you.
Your cost.
Generally, yeah. If you buy something, your basis starts as the purchase price plus certain costs to acquire it, like sales tax or certain fees. Then you might add costs of capital improvements, things that add value or extend the life, not just repairs. And basis gets adjusted down for things like depreciation deductions you take over time. So it changes.
So cost plus improvements minus depreciation, roughly.
That's the core idea for purchase property. There are special rules if you get property as a gift, or inherit it, your basis might be different then, and rules for stock, like if dividends are reinvested.
Why is basis so important?
Because it determines your gain or loss when you sell or dispose of the property. You only have taxable gain if what you get for it, the proceeds, is more than your adjusted basis.
Proceeds minus basis equals gain or loss.
Exactly. Section 61 and 1001. No gain if proceeds don't exceed basis. And you can only deduct a loss if the code specifically allows it for that type of property and situation, like business assets or investment property, but usually not personal use assets like your main home, unless it's a casualty loss.
So knowing your basis is key to figuring out the tax hit when you sell something. A house, stocks.
Absolutely critical. Otherwise, you don't know how much profit is actually taxable.
That really clarifies it. Basis is what you've put in, tax-wise.
You got it. It's the starting point for figuring out the tax result when an asset changes hands.
Well, wow. We have definitely covered a lot of ground in this deep dive. From the IRS and the code itself,
through the Treasury regs and rulings that interpret them, the judicial doctrines courts use,
the whole process for tax disputes, from appeals to the courts.
And finally landing on those fundamental building blocks. Income, deductions, credits, and basis.
Understanding these pieces really does give you, the listener, a much better framework for dealing with federal income tax, doesn't it?
Absolutely. Whether it's for your business, your personal finances, or just wanting to be informed, knowing who does what IRS, treasuries, Congress, courts, and what these basic terms mean, it just empowers you. You can approach tax info with, a bit more confidence.
You see the whole ecosystem.
Yeah.
The law from Congress, the interpretation and enforcement from the executive side via IRS and Treasury, and then the courts stepping in for disputes and final interpretation.
Yeah, it's this dynamic system.
It really is. And maybe a final thought to leave you with. Consider that interplay, the code passed by legislators, the regulations from the executive agency, the interpretations and doctrines from the judiciary. How does this constant interaction, this layering of authority, affect how predictable or even how fair our tax system feels? What parts of that dynamic do you find most interesting or maybe even concerning? Something to chew on.